Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, June 10th, 2021. It'll be a quick one. Just want to tell you what I'm watching, what I'm looking for today. A couple different sectors in the broad market. This is the S&P 500. This is just a simple view. The primary trend line right here in white comes off the March 2020 lows. And that one was recently broken back tested, but we're kind of, again, moving sideways here. The bigger picture is the last few months is kind of a sideways range right here. And then you have the secondary trend line right here in purple with these reaction lows. And so we need to see that go now. As I mentioned recently, my focus has shifted largely in recent weeks to two of the strongest sectors in the S&P 500, and that's the financials and industrials. So what I want to point out, watching the financials, they were actually up in pre-market. Here, let's look at a 1-minute chart and we'll take a look at what they did today. Let's even turn on the pre-market trades right here. So here's what happened. So this is yesterday's close. When you're looking at this chart, the green and red candles are the regular session. Then here's the after hours and pre-market. In other words, that was up until after the bell yesterday and then this morning. And this is why you don't take too much into what happens in pre-market. So this is where we moved up in pre-market, and then look what happened after the open. They came in selling it hard. Now look, is that a big change in the, if you turn off the intra or the after hours charts? And again, it's only 1-minute charts, so keep that in mind. We're only down 0.19%, but it is, an additional check marks. You know me, I like those check marks. There's no absolutes in trading. You can only increase or decrease the odds or probability that something's going to play out. But so far, another red candle, so that makes 1, 2, 3 consecutive days. Now, this day is not over yet. This candle can turn green. This candle can go and take back the trend line. It may backtest the trend line, or it could build on today's losses. And as I like to say, the redder the better. So if I get a red candle today, that's an additional check mark. And if I get a pretty, good move down, even better. And again, I think this will have, I believe it'll have implications. Sometimes I spot things that don't pan out. I highlight developments to watch for, and they don't pan out at all. Sometimes those developments pan out, but then the other part of it, I trade, very, complex. So markets are integrated, complex machine. There's a lot of moving parts, and quite often what I look for is something maybe that others don't see. One thing that then may affect others, and that again, that's what I'm looking at here with the financials. And so far, so good. Let's just leave it at that. Told you there's a sell signal on them yesterday, and that sell signal will only firm up if we have another red close today. So let's just keep it at that. I wanted to talk on the industrials as well, and tech. Before I get to the industrials, because I'll wrap it up there, I'm just letting you know how I'm going to do the video. I'm going to talk on tech real quick. Tech was pretty strong out of the gate. Now again, nothing big when you're looking day to day, but we had a lot of buying on the tech stocks early in the morning. You can see this is a 1-minute chart, what I'm showing you. Sometimes I don't make clear. This is a daybreak line right here. So there's yesterday's close. See that yellow line right there? That shows where we closed yesterday. So they bought up Apple, but so far fading it. They bought up Microsoft right there this morning, holding up Visa. But again, on a 1-minute chart, you're looking at a very small, minute time frame. It doesn't change anything on the daily chart. But the point that I'm trying to make here is the one thing that would actually be healthy for the market, if I am right on the correction in the industrials and the financials, is if tech takes the baton from those and starts to resume its previous leadership role. Tech, the tech stocks, big growth, Apple, Amazon, Microsoft, Facebook, all those guys, historically have been the fastest growing companies and market leaders. And for many, many months now, as I've discussed, they've stalled out. This is the trading range. You turn all the lines off, and this is just a sideways trading range now for many, many months. And can you chalk it up to bearish? No, because unless they drop, that's clearly bearish. You can make what you want of this. From what I've seen in the past, it is typically not a healthy sign when the market leaders stop going up. You can spin it glass half empty that way, and again, that's been my experience more often than not, especially in conjunction with some bearish technical formations, divergences, things like that. the glass half full or optimistic approach says, it's healthy market rotation. Tech got ahead of itself, had a big run up after the COVID drop last year, and now, while tech consolidated, industrials, financials, others took the lead, and now maybe tech is ready to resume. So that is the bullish scenario there. It's not my preferred scenario, but it's certainly one that you cannot dismiss, and you have to recognize it, and therefore I'm going to keep an eye on tech. Because if we get a correction in the financials and or the industrials, but tech starts to really, money starts flowing out of those names because they're a little overdone, and that's one reason I've been highlighting those as waiting for sell signals in the next objective short entry because of that. So one of two things is going to happen, is what I'm getting at, if I'm right on financials and industrials, is the money, as they go down, that money's coming out, there's profit taken by the institutions as well as individual investors. Where does that money go? Does it turn around and flow into other sectors? Doesn't have to be tech, but of course tech has the highest weighting, and tech should rally if that happens. And if so, then that is, not a bad thing for the market. In fact, that could be quite healthy. Again, healthy sector rotation. However, if money comes out of those and it also comes out of here, then guess what? Now that tells us, if the majority of sectors, especially the leading sectors, are all under selling pressure, it means the supply-demand dynamics have shifted. And at this point in time, or that point in time, if it happens soon, it means there are more sellers in the market than buyers, and that's when stocks go down. It's that simple. So that's what I'm watching for. Now let's look at the industrials. As I told you, I'd go through those. Right now we had, like I said, pretty decent, not great, but decent sell signals on XLF, and some, but not all of the big financial companies, individual financial companies. XLI, let me see if I have two boards. Well, there it is. There's a clean trend line if you just want to see. This is the lows back in March of last year after the pandemic first hit and the markets dropped. So it's the same primary uptrend line, and you can see we broke it on this board here, at least the way I have this drawn. Trend lines are subjective. That's why I have different boards. Sometimes I'll tweak it. This trend line's a little bit different. In fact, let me go back to that one and make these the same. And what I'm doing there, coming in, and then I'll just come to the body of that candle. I like to hit my trend line drawing. Typically, I like to look for the most number of reactions on either the body or the wick. And in a case like this, when you have a meltdown kind of sell-off and then a reversal, quite often I'll use the body of that candle or even cut into the candle. Again, the most important thing, I think, to me, are the most recent reactions, and there's quite a few there. So give or take, this is our trend line, and like I said, it's not ideally you want to see a breakdown and then just follow through red selling, but we are moving lower, and we're clearly below the trend line any way I draw it. Any way I move it or draw it to come in and catch those previous reactions, we're below it. So let's take that for what it's worth. And again, not a screaming or high probability sell signal, but one that I think will play out. And again, there's other factors that go in, such as the divergences that have been building, and then most recently the divergences have really gotten a little more steep here, if you will. The slope of the divergence lines on that recent roughly equal highs there on the XLI. All right, enough of that. Let's go through, not all, I'm just going to go through the top dozen or so holdings, and again, I'm going through these in order of market cap. That's how I have my watch list sorted. You can't see it, but to the left or right of this chart, when I enter an ETF, it'll populate all the holdings, and I have those sorted by market cap, because usually, not always, but usually an ETF or a sector will put a higher weighting on the larger companies, larger by market cap. All right, so I'm going to start out here, top dog being UPS, and that's $184 billion, or 184 billion. And so what stands out to me is the divergence that's been growing now for many months right here. So you have a big divergent high, and bigger the divergence, usually the bigger the correction. No guarantees. There was a divergent high back there. This correction, and sometimes you break down. I talk about this often, and that's it. and the correction comes. Sometimes you break down. In fact, technically speaking, I need to do this. We had a slightly higher high right there. So the divergence extended after the trend line break to put in a marginal new high right there. And that's the one that did the trick. And then from there, UPS fell. It doesn't look like much, but that was about a 35% drop. Previous divergent high drop, divergent high drop, divergent high drop. You get it? That's it. All right, so far this one's starting to move lower. Hit the 50-day moving average recently. They came in and bought. Let's not spend too much more time on it. And you can see lines that I don't see any support. The first support that comes in, it's minor. I think that one will be hit. There's my target right there, 180.52. And that's the bottom of the gap. But so right here you have the top of the gap right there at 190. But here you have more reactions, or right there, almost there, and right there. So minimum target 190, preferred target 180.52 right there. And based on these divergences, I would expect a reaction, but I think it will ultimately, there's a good shot if we can get a decent correction going anytime soon. In the coming weeks to months, we work our way down to about 155 right there. That's very good support. And at that point, I would be interested in stepping in if the chart's confirmed to go long UPS. And remember, the reason I do this is not just for individual trade ideas, not just for analysis, because I know some of you listening to my voice probably own some of these companies individually, and if not, maybe you own the Industrials ETF, and if not, you own an S&P 500 index fund, most likely in your 401k, IRA, or something that's heavy in the market. And remember, it's the S&P drops, everything's going to drop, and so therefore, if the industrials drop, it's going to put pressure on the S&P. All right, Honeywell, HON. What do I see there? Negative divergence building up to this point right here. I need to move that line to right there. That's our most recent divergent high. There's our primary trend line. It was pretty clean. We broke it, and actually broke that one pretty impulsively. Look at that red candle. That's what I like to see. But this has just been a resilient market. So that was a breakdown. That was a sell signal. We back tested. That was an objective short entry. And then from there, if you shorted the back test, dropped down about 5%, nothing big. And again, sometimes you break down and don't look back. Sometimes you break down and back test once, twice, several times, and it pans out. And in a super strong bull market, they'll just shrug off these divergences and continue on to new highs. And then the technicals aren't working, at least not the way I see them. I still think they will. But what do we need to see to increase the odds? Well, it would certainly help, since we've already back tested here, to start moving lower, come down to that 216.33 level again, and then break it. We've already tested it once successfully. Usually the first tag of a support from above will produce a reaction. Often, not always, but often. So if we get back down there, that would be a break of that level. Solid break would be a definite sell signal and would open the door for my next target down there, about 194.27. Let's put that in percentage terms to try to see how it'll affect Honeywell. If so, that would be about a 5.5% drop, and then down there about a 15% drop. Next up, UNP, Union Pacific. It's a railroad company, of course. Primary uptrend line is nice and clean. I like this trend line. I like these railroads. They trade well to the technicals. You can see my last trend line I had here. There it was. Boom, breakdown. It was impulsive. Nice correction there. Tradable correction. Came back tested, and that was it. So that was all we got. Moved up, set up this next uptrend line, also with divergence right there, and breakdown. And there's your big level right there. It's about 219, just shy of that. I have it at 218.95. Good support. Look at all these reactions, plus these reactions from above. So that was our previous all-time high. There's your breakout candle. See how we didn't limp through there? Big solid green candle, and then back test, back test, back test, back test, back test, back test. Recently tells me you can set an alert, and I'd give it a high probability short entry if that level's taken out with conviction. Again, about 218.95, and that should open the door to these targets down here. That's about 205.70, and let's just focus on that for now. Well, first things first. Let's see if we can get some additional sell signals here in the sector. That'd be about a 7.3% drop. Boeing. Not crazy about the chart. It's a big industrial, no doubt about that. But I'm not going to spend a lot of time on it. I don't have a strong opinion on that one. RTX, Raytheon Technologies, nice, clean. Look at this wedge. Look at that nice, clean up trend line right there. There's your divergence line. And most recently, we've got divergence now on the RSI right there at this point here. And let me give you a target if you're interested in it. It's definitely first support. I'll have to spend a little more time studying this chart to give you some levels, but there's a couple early ones right there if that breaks. And again, the takeaway is the technical posture of all these. How many look like they're poised to break down close to support levels with the negative divergences forming, and how many have already broken down. And so when I go through, and I'm not going to spend much more time, we're almost done here. I've got maybe half a dozen more. You can look at it this way: if I cover 15 or let's say 20 stocks, and these are 20 check boxes, and I have a dozen of those check boxes checked, meaning clear, solid breakdowns, then that tells me, guess what? That's good odds. Let's short this. Let's be short this sector right now. But if I cover 20 stocks and 16 of them are still above support, even if they look bearish, with divergences, but they're in a bullish trend, guess what? No check marks there because sometimes look, I live in South Florida. I'll use an example, especially now. With June, our rainy season starts, and we're the monsoons down here. We have thunder showers almost on a daily basis. And you can walk outside sometimes, the temperature drops 10 degrees. The skies are black. You hear the thunder, you think it's going to rain. And guess what? It misses you, and it rains a mile away. That's how our thunderstorms are here. They're localized. So in other words, sometimes you say, oh, we're about to get hit with a storm, might rain, and you miss it. So sometimes it looks like you're going to break down, but guess what? If you don't get the sell signal, sometimes these stocks can power up. However, with that being said, Caterpillar, one of the most beautiful charts that I've seen so far going through these in industrials. Look at this trend line. I mean, look at that, off the March lows. Count these reactions. These are clusters, but there's 3 distinct reactions, so that's one cluster. 2, 3, 4, 5. And then for the last couple weeks, I mean, you tell me there's no significance in that trend line. Say what you want about technical analysis, but that is hard to argue that this trend line is significant. And then you had a pretty decent red candle, your breakdown candle. Boom, there's your check mark, your sell signal. And so far we're falling through to the downside each and every day. So there's one on a sell signal. Big industrial Caterpillar. My minimum target and first target's 224.15. Probably get a reaction there. And once that breaks, 190.80, 197.80. That's, let's call it my preferred target now, and that'd be about a 16% drop. And then if that gets taken out, we head all the way down to about 181.60. So one of my favorite, very nice shorting op right there in my opinion. GE, General Electric, simple stuff. I'm not always just looking for divergent highs. See divergent low, that's bullish. There's your divergent low. There's your last divergent high, and again, divergence in itself is not a sell signal. What is a break of a trend line. Boom. And then look at that beautiful bullish divergence right there on the divergent low, and that would have took you in, got you in there. And now we've come full circle. Divergent high. Time to drop. No sell signal yet. Well, yeah, kind of. This one is one that it broke down actually. G broke down right here. And it's been moving sideways. So we broke down. We never took out that previous high. We only made an equal high. So if you shorted there, it was objective, and you're still, you might be slightly under, yeah, you would be slightly underwater, but well within a reasonable stop loss. Because if you're trend trading, you're catching these moves right here. That divergent, let's see, that divergent low was good for a rally of. If you held up to the top, I'm playing the game of timing the bottom, selling the highs, and that's not so easy. But just imagine you caught a good chunk of that, even that initial run up there, 82%. If you held it to the high, 110%. If you turned around, if you were short at the divergent high and to the bottom, 59%, or any part of that on the way down. And again, if you went long that divergent low, up 161%. So what I'm trying to do, again, I'm showing you the maximum if you caught every bit of the trend. But even a small part of that trend, And so that tells you, look, we're talking triple digits on most of these trends in GE. So, there's no reason to believe that this next drop, when it comes, won't be at least in the mid to high double digits. So that's GE. 3M, Minnesota Mining and Manufacturing. There's your trend line right there. Some divergence. Not one of my favorites, so I'm going to move on. DE, and again, we're going to wrap it up soon here. DE, John Deere. So there's a theme here. It's these the agricultural, farm and heavy construction machinery like Caterpillar, John Deere. They've broken down. They put in divergent high. Look at that, beautiful uptrend line on John Deere. Zoom in a little tighter. There's your breakdown. We've been dancing on this 352-ish support for a while. Once that goes, and we're starting to crack, a little more downside. If I could just give this one a little nudge, it should go over the edge. I always use that example when you're a kid and you see your friend on the side of the pool. You give them that little push, and no matter what, they're going to lose their balance and they're going to end up in the pool. That's what this thing needs, that little push just to get it, and then once it goes, it's going to fall off the edge of the pool and dive in. Like that right there. That would be my target, 317.58. Probably get a reaction there, and then if things get ugly and we can get some real traction on a correction, 265. So that gives us downside potential in John Deere of about a 10% to the first target, and about 25 if you're willing to hold out to that second target. Lockheed Martin. What I see on this one, LMT, pretty big resistance right here at about 401, call it 400, divergence forming. Maybe it wants to push up and get up there. If not, there's our uptrend line, there's our divergence. I could see another thrust up in this one potentially. Not that I would go long, it's not worth it. Risk reward, upside potential is about 3.25%. Doesn't outweigh the downside potential. FDX, FedEx. See, I think what's happening, remember I started out with UPS, the first one, and here's FDX, FedEx. Similar posture, big divergences building. There's your minor trend line, or it's actually the only uptrend line I have right now. That needs to break, and that should take this stock back down to 231.79. I think these guys, UPS and FedEx, I know if this continues, this rise in oil, remember, this commodities are, inflation's out of control. I don't know if you guys caught the headlines today. The CPI came in. Let me just check the headlines here. Consumer prices rose strongly again. I'm reading off another monitor. Consumer prices continued to climb strongly in May, surging 5% from a year ago, the highest annual inflation rate in nearly 13 years. That was this morning. So now what does that mean? Well, crude is obviously benefiting the rise in commodity prices, and that's big expense obviously to FedEx and UPS. They get to fly their planes, drive their trucks, and so forth and so on. Almost done. Let's see where I want to stop. We're going to go through a couple more CSX because I showed you a few railroads in here. There's my trend line, divergent high 1, correction, divergent high 2. Needs to break right here. Big level about 97.39. You want to be safe, call it $97. Break of that would take you down to 87.25, and that's a drop of about 10%. That would be the first target. Second target's there about 81.29. ITW, Illinois Tool Works, starting to crack trend. So again, that's doing this to show you a lot of them cracking trend, but quite a few, just like CSX before, they have what I call them BOD support levels, benefit of the doubt. That was support, and it is broken, but it's not very impulsive so far, and you have horizontal price support just below. So that'll greatly increase the odds. A break of 221.50, a solid break, greatly increase the odds we head down here to that next target, and ultimately all the way down here, maybe to about the 190-ish area, 192. NSC, another railroad company, Norfolk Southern, it's already broken trend. So there, boom, another one, check mark. First support, 256.92, then 228.91. Last one, I don't have anything on this. We're going to stop it here. All right, guys, so there's what I'm watching. I'm going to watch the financials. So what I want to see today, I want to see more downside in the financials. As I say, the redder the better. To confirm the breakdown. Right now, as I said yesterday, I think it's an objective short entry, and I gave you FAS. If you want 3-time leverage, or FAZ, I'm sorry, for the 3-time leveraged financial short. You buy that long. Keep in mind when I went over those inverse ETFs, you don't short them, you go long because they're already inverse. SKF, it's up about nothing much today. These guys are just, I think we're early on this, so that's where I like to get positioned. And so as I see additional evidence, I'll continue to layer into those shorts on the financials as well as the industrials and or the broad market, because that's, again, if you want to keep it very simple. You say, Randy, that's too much. I can't trade individual stocks. I work a job. I do this. I don't even want to mess around with sectors. I just want to be long or short the indexes. Well, my theory is that this breakdown in the financials and industrials will spill over to the entire market, take the S&P down with it and everything else. So therefore, you can be short the S&P or you can be short the NASDAQ 100. I still think once we get those financials, I think the S&P might keep up. Usually, I would say this, usually when you get a rally in the market, if you're, the two of the main ones I follow, QQQ, the NASDAQ 100. I can't draw it out here. We can do it this way. The Qs, QQQ, and the S&P 500 SPY. QQQ tends to go up more in percentage terms than SPY, and this would be SPY right here. And likewise, on a drop, QQQ usually falls more. But at this point in time, remember, QQQ has already been underperforming for a while, and whereas SPY has been outperforming, and therefore SPY may keep pace. I always like to mix it up. And the small caps too, they should fall. They usually fall even more than both of these together when there's a broad-based sell-off. All right, let's wrap it up here. Get the video out to you, and that's what I'm watching for today. This has been Randy Finney with Right Side of the Chart. Have a great day.